Okay, so we're excited to be here. Obviously, you know me. This is my brother and business partner, Chris. So he'll be doing a large majority of this training today. But I think really we want this to be a discussion. As you'll find in our slides, there's going to be lots of questions, lots of things that we want you guys to be thinking about as it relates to really your finances. And I think what we learned in the cohort is just how critical the finances are, and that we are on top of them, that we understand them. And in talking with Dan and some of the feedback that we got, there was some feedback that came in last night that we weren't able to incorporate. We'd already had our kind of our slides done. But if there's time at the end, we're happy to go over any questions. But let's make this a discussion. If we don't get through all the slides, that's not what we're worried about, right? We want to make sure that if you guys have specific questions, but what we did want to talk about in some of the common themes was really navigating through some of the financial challenges and pitfalls that most businesses fall into as they are within their business, whether it is a startup business that's kind of getting going, or if it is something where they are in the growth side. Like, there's all of these different aspects of the business that you have to be overseeing. So this is kind of the agenda for the day. So we're going to be talking about cash flow management. I know that within the cohort, we didn't talk a lot about cash flow forecasting, but this is something that's critical. So we thought we could go over cash flow forecasting, talk about cash flow burn rate, if you know what that is, or how to track that and things there. We're going to talk a little bit about the difference between gross margin and profit margin, and what they are and the significance of both of those. And then really just understanding financial statements. I don't know how in depth we'll go there, but a lot of that will just be based off of questions that we have. We'll go through a few things that is kind of top of mind for us. But I actually like this picture. So if you kind of look at this, right? So you have this start. I love this picture where you've got your challenges, your ideas, you run into these kind of loopholes that you're not expecting, and that's really what we want to cover today. And so as we're going through some of this stuff, don't hesitate to pause this and say, well, what about this? Because we really want this to be a discussion. We want this to be something that's helpful for you. We took some of the input and try to create kind of this platform or agenda to really fit the needs of most small business owners. And so if there's something that we want to kind of tie into something more specific, or as we go down, then we can do that as well. And then I'll probably just kind of plug in. So I'll turn the time over to Chris, let him kind of go, and then I will just kind of jump in from time to time and add my two cents. So we'll go from there.
I think that taxes should probably be the bigger problem here, right? Right when you feel like you're getting up to the top, taxes are there just to draw you down. What does 1040 mean? Like the form 1040? Do you know what that actually stands for? That's it's the personal income tax return, right? It actually stands for every 50 you make, you get 10 and the IRS gets 40. Just so you know. Right? Yeah, that's what it feels like. So let's jump right into it and talk about cash. Cash is king in the small business world. And it's super critical, obviously, because you've got, especially in the new businesses, because you don't have a lot of cash. I mean, and you've got to have that cash to hit your payroll, pay your suppliers, whatever it is. You've got to have that cash ready to go, and you need to know that you've got it so you can sleep at night. Are you generating positive cash flow or not? How do you tell that? What do you guys do to know if you're generating positive cash flow? One of the easiest ways that I've done it is I look at the ending balance of my bank account 1 month versus the end of the end of the next month, and just honestly look and see, is it increasing or decreasing? It can be that simple. Usually what I like to do is plot that out on a spreadsheet. So month at a time, put the ending balance in there, and you can do that with all of your bank accounts, and really just plot it out. Is it growing or is it shrinking? It really is that, it can be that simple. And I like to do it over a year as well of time, so you can actually look at February 2024 versus February 2025, and does the balance increase or decrease from that point? There can be some things that might throw that off though. So what if you get a loan during that time frame and it increases your balance, Is that really considered positive cash flow? No, it's not. And so you have to exclude some of that stuff when you're doing this analysis. So anyways, when I do that analysis and I take the year's span and kind of watch what it does, ultimately if it increases after I've taken out those one-time either expenses or positive cash flow deposits, and I divide that by 12, that gives me an idea of what my monthly cash burn rate is. And ultimately you want that to be positive, right? That means you're actually generating cash and not burning it. So some things just to kind of help manage some of your cash, and this is a big one, collect before you pay. If you have a lot of cash that you can bring into the business, it's okay if you're upside down at first, because that'll eventually come back when you exit the business. But if you're like me and Scott, we didn't have a ton of money when we were coming into the start our business. We needed to make sure that we set it up to where we were collecting from our customers before we were paying our people and before we paid any suppliers and stuff like that. And that's just a matter of payment terms, right? There's lots of ways that you can collect. Our invoices are due upon receipt. Not everybody pays that quick. And so we've established a process where we actually can charge customers credit cards at the very beginning of the month. And so that way I've collected my money. I know how much cash I have to spend the rest of the month. That's one option. Trying to structure your business to where you're collecting first and then paying after, that enables you to have enough cash to fulfill any debt or any rent payments or pay your people, whatever it is. Whatever you can do, try and shorten your payment terms with your customers or have them pay half so you at least can break even at that point. We have similar situations where we're doing cleanup work for clients. It can take a few months and it takes a lot of manpower to do that stuff. And so we collect half up front in those situations so that we can at least pay our people and pay any other obligations. So we at least break even if they don't end up paying. And that's happened before, right? We've had clients that don't end up paying and it makes it tough. And then anything you can do to lengthen those terms with the suppliers. And there's some creative things that you can do with payment terms. If you want people to pay quickly, you can offer discounts up front, like a 2% discount if they pay within 5 days. And a lot of times your suppliers can offer those same kind of things. Another thing that I don't know if you have salespeople in your organizations, but trying to structure it so you don't pay your commissions or any sales bonuses or commissions until after, or you collect from the customer. That way you know that the customer's real and they're in it. That way we're not front loading that commission payment before we actually know the customer's going to pay. Who here has done a cash flow forecast for their business? So yeah, it's like shooting a bow and arrow from 500 yards away and the wind's blowing and it changes directions. So it's pretty tough, but you're right on with looking at what has happened in the past, right? Do you have a seasonal business or not? Is it even seasonal with the day of the week? I mean, that could happen as well. I'm glad that some of you have done cash flow forecasts. I've got an example of one that I've done in the past. It's on the next slide. It's pretty simple. I like it because it's predictable and honestly, it helps you understand your business if you go through and kind of build something out like that. Essentially, if you're losing money, let's say that your net income is $5,000 negative during that month, you have to calculate what you need in sales in order to make that net income zero at the end of the month. So a lot of factors include your sales and your cost of sales to get up to that point and any other variable costs. So we can dive into that a little bit and help you guys understand how to calculate a break-even point. The reason why a break-even point is good is it gives you a goal to reach. I mean, it's great information, but if you know, like, I need to bring in 5 more customers or I need to sell X many more units, it gives you something to push towards, come up with a plan, like marketing-wise, what I need to do to get your business up to that level. And then you can set goals beyond that to make more money. Seasonal businesses, they will have times of feast and then times of famine. There are some annual seasonalities, right? There literally can be monthly or weekly, daily seasonalities that are important to look at. And then you've got real estate agents who have years of feast and then can have years of famine that they're dealing with. So there's lots of different types of seasonality that people have to deal with. I realized how critical it is to run a business with a budget. because it gives you that roadmap to where you ultimately want to be. If right now your net income is $100,000, but you want to actually double that, you can actually put that in a plan, say, okay, these are going to be my expenses. What do I need as far as sales in order to hit that goal? And then you can start building plans around how do you get that sales target number. And so it really is that roadmap to help you make whatever money you want to make, or build out whatever product line you want to do, or open up that extra store or that second store. Like there's a lot of factors in play, and without a budget, it makes it difficult to really figure out what you need to do and when you need to do it. As an accountant, I love a conservative budget, but that's not how you should budget. Like you don't want to necessarily make it to where the budget is right on. You want to be able to, in my opinion, as a business owner, you want to set a high budget. If you want to grow your business, if you want to make more, you need to set high goals, and even a 5-year plan with a North Star that's, I'm at $1 million in sales this year. In 10 years, I want to be, or in 5 years, I want to be at 10 million. And that type of plan, that long-term plan, is going to help you get bigger faster than a smaller, more conservative type budget. The guy that helped Scott and I with our business as a mentor, I remember our first budget, he challenged it, because I set it as an accountant, and he's like, you guys can do a lot more than that. And so we went back to the drawing board and we increased our budget, and I thought, there's no way in heck we're going to get this. But you know what? It pushed us, didn't it? It pushed us hard. And when we looked at our actuals versus our what we budgeted, the revenue mix was completely different than what we had anticipated. But we had almost hit that budget, so it was great. Like we pushed ourselves hard. It was a lot of uncomfortable growth, but we were able to expand pretty good. So that's budget-wise and forecast long-term plan-wise. When it comes to cash flow, you need to have that more reality, and not pie in the sky. Like, oh, I had 10,000 in sales this week, I'm going to hit 15 next week, but you really don't have the ability to actually do that. You know what I mean? That's just setting yourself up for failure. I like to use my budget as well, because we set our revenue goal, and then from that I can plan, okay, how many people do I need on hand or on staff to support that revenue? That's more sales than Scott can handle, so when do we hire a salesperson to actually make sure that we hit that revenue growth? One of the other factors or important things with budgets is that you make sure that you actually watch what your actuals are compared to your budgets. And that's hard if your budget is just in a spreadsheet. Most accounting systems now, any of the online ones, will allow you to load up a budget, and then you can compare your actuals to budgets as they come in. That way you can see if you're on target to hitting your goals or not, and you can make adjustments as needed. Unless if you're like a weekly type business, there's a cleaning service that I do CFO work for, and they run on a 4-week cycle, and he can look week by week how things are looking, because it's pretty consistent that way. But I would say quarterly at a minimum, but I would ideally say look at it on a monthly basis. So you've got your budget, that's the roadmap, and it lets you know where you're at on that map. Do I need to make adjustments to cut costs, or do something to increase my revenues, or something along those lines? So let's take a look at a simple cash flow forecast. It's just an Excel, so it's all free. There are some softwares that you can tap into that will pull information right from your accounting software that will help you build forecasts and stuff like that. But they come with a monthly subscription. As an accountant, I'm cheap and I like free, so I use Excel quite a bit. So this is an example of a daily cash flow forecast. So what I always start with, and there's 4 main sections, right? So we've got what we currently have in the bank, what we have, like we feel like is coming in during the month, what we feel like is going out, and when it's going to go out, and then we have our estimate of what we feel like the month end or that daily cash balance will be. And this is, If you don't have a lot of cash in the bank and it's a little struggle, you're not sure if you have enough money to make payroll, in 2 or 3 weeks, you've got to have a daily cash flow forecast. I've had this with a seasonal business that I was a CFO for. We were a software business, and we had 2 months out of the year. It was usually January and July that were really big. We would send out annual contracts at that time. We'd get millions of dollars in, but then after that, we would hardly bill anything. And so we had to have that cash last for 5-6 months. And at the end of that 5 or 6 months, I was not sleeping well. I was not paying my suppliers. So it was a struggle, and I had to rely on a daily cash balance. Do I have enough money in 2 weeks to hit payroll? And that's a real thing. It's a real challenge for business owners. And so I relied on this methodology a lot, and I found that this was easy to update, and especially if you can come up with a list of some of these large vendors or payments that you feel like you're going to be making. You can just list those in a list, what day you typically pay those, and then you can easily build out the next month forecast by saying, okay, my payroll is on this week and this week. And my inventory, I'm going to have to restock that, weekly on Fridays or whatever it is. So you can come up with some of those systems like that to simply just put in those numbers, copy and paste it in, and build out the next month's cash flow. One of the best ways to do this is what Sarah's point is to look at those historical numbers and see what day does my cash typically come in. Do I have big days or small days? And so that can be different for everybody, especially if you're in a retail environment. It's kind of tough. But just coming up with some type of average so that on average, I'm expecting this much money deposited to my account. And again, try and guess on the low end so you're a little bit more conservative. If you have extra deposits, then that's just gravy. And then I like to itemize out these large expenses. So what are some of the large expenses in your guys' business? Payroll's probably number one, right? That's really high. Rent, that's very predictable, right? It's always the first of the month or a few days before. Hosting, inventory. So those are all large and hopefully somewhat predictable expenses. And better yet, hopefully they're variable type expenses. So you probably have some stuff on stock, but a lot of stuff you may order in. On situations like that, what I would do for a cash flow forecast is I would estimate what my sales are going to be, and then have that be my materials cost is a percentage of my sales. And then you can just have a formula that whatever you put in here in your sales, it will automatically calculate that way. In QuickBooks and in other softwares, you can actually do, and it starts at the transaction level detail, but you can assign a project. Well, you can create projects in QuickBooks, right? And say this is project number 1, and we're going to install an HVAC system at Slick. And you tag all of those expenses related to that specific project. It still flows into your main P&L the same way, but you can track projects individually and see if you're making money on each project. And then if you have more product level type stuff, you can actually implement a thing called classes. It's almost like a department, and you can use that to help assign costs to a specific product to help you understand if your product is making money. But in order to do that kind of stuff, you've got to have the data available. If you can't split your payroll or your materials costs by project or by product, then it makes it almost impossible to figure that out. Yeah, setting up the chart of accounts, so making sure that you've got the appropriate income and expenses labeled, and then and really any other ways that you can segment or slice the data. So there's locations in QuickBooks, there's classes in QuickBooks, there's There used to be tags, but they're getting rid of tags. They have projects. So those are all different ways that you can, make your data a little bit more three-dimensional. If you have people costs, QuickBooks does have a QuickBooks time system that you can use they can clock in on a certain job and then clock out, or just say I worked 3 hours on this job. But there's other systems as well that integrate well with QuickBooks. So then we talked a little bit about cash burn rate. This is at the end, if you look at this isn't a full month. I just wanted to make sure I had enough real estate. But if you add all this stuff up at the end, we started with 50,000. We ended at 49,250. Those numbers ultimately show up here. Actually, no, it doesn't show the beginning and ending cash. This is just a sum total of the incoming and the outgoing. So at least I can see how much I've got coming in and how much I've got going out to see if I'm positive or negative. And so this kind of gives you an idea of what you can do, hopefully, which levers you can pull to maybe make this just that much closer to break even. So this little picture that we put in here, so MRR is typically, it stands for monthly recurring revenue. And this is not a graph of this, just so you know. But this is, if you were to do a monthly forecast, or even a quarterly, this looks like it's probably monthly. But on this, it's saying that this is your revenue that's coming in. This tall bar is the money that's going out. And so this line is showing that they are burning this much cash each month. And as those right size and even flip places, you can see that it finally switches right around here where it becomes positive. And so it's nice to see this kind of view. And this is your cash balance. So you've started up here. As you burn cash, you go negative, but then once it turns positive, you start coming up into the positive cash. In order to build some type of chart like this, you have to have, any of your cash inflows, your cash outflows, and then you can literally build a chart that looks similar to this. Monthly data like this, if you were to look at the historical, this would give you an idea of what you're looking at or what your business does. And you can actually download a lot of this stuff from your bank. You can get it to where you put all the negatives in one column, all the positives in another, and you can just build it together that way using just your historical data on a cash flow basis. So anyways, this is kind of how you would calculate a cash flow burn rate. You just want to know if you're making positive or negative cash. And hopefully it's instead of a cash burn rate, it's a cash producing rate. One of the best types of businesses is something with this MRR. If you can get returning customers, that's very valuable. And not all businesses are built like that. Like an HVAC company, it's tough to find that kind of stuff. We've had some plumbing and HVAC companies, and they try and do something where they're selling some type of subscription. We'll come in and we'll replace your air filter every month. I wanted to dive into gross margin and gross or profit margin. And a lot of times people use those interchangeably. So that's why when you were talking about that, I was like, okay, which margin are you talking about? Because so gross margin is typically just the net. That's essentially like what we've got here, your sales minus your cost of sales. When you sell the inventory, how much you collected versus how much you paid for that inventory, the cost of goods sold. So that's how you calculate it for the gross margin. So if you actually sell products, it's the cost of the physical products. If you sell services, it's the cost of the services. So our business, our cost of goods sold are the people costs. This is before overhead. This is strictly, how much am I, if I buy a widget for $5 and I sell it for $10, I've got a 50% profit gross margin. I wanted to first ask, I should have probably put this in here, but who knows their gross margin? And I would work towards getting that. And this is, again, you got to structure your chart of accounts, your profit and loss statement, so that you can see that. It really should just float right up to the top, so you can easily calculate the gross margin dollars divided by your sales to come up with your gross margin percent. There are some systems though, like ADP, for example, you can set up departments within the payroll system, and you can have all your producers in one department. So you can just make a journal entry or a payroll expense to cost of goods sold for that. So I like to use departments within payroll so that I can split out my admin from my direct labor costs. Yep, and that's usually, it doesn't cost anything to do that. I think QuickBooks Payroll does that stuff too, but they have a really big flaw. I don't know if anybody uses QuickBooks Payroll, but they don't automatically file your taxes for the state of Utah, and yeah, the 941s for the state. No, and there's some real issues with that. I don't know why, and I think it's just a few states. So that can really get you. I would challenge each of you, if you don't know your gross margin, talk to your accountant, talk to your bookkeeper, try and get your chart of accounts lined up so that you can see your sales and your cost of sales right up at the top of your profit and loss statement, your income statement. And then you can simply just take the net gross margin amount, divide it by sales, and you've got your number. And there's some challenges to that sometimes, so we've talked about how you calculate it. One of the challenges is matching your sales and your expenses. So if you're trying to look at a monthly gross margin percentage, especially if you're in an inventory type business, buy inventory and it just goes straight to your cost of goods sold. You don't have inventory in your balance sheet. If you book that right to cost of goods sold and then you don't sell that stuff for another 2 months, your sales and your cost of sales are in 2 different months. And so it's going to throw off your gross profit calculation, or your gross margin calculation. So I like to, as a benchmark, look at the full year of revenue and expenses, or even the last 12 months to see what my percentage is, because that should help smooth out some of the peaks and the valleys and give you a good idea of what your gross profit percentage is. So that leads me to my next question. How do you know what a good gross margin percentage is? The other thing that's great, I love now, ChatGPT, if you just type in, what is a good gross margin? Yeah, just type in ChatGPT or some other AI and say, what is a good gross margin for the HVAC business? If you're comparing yourself to your historical margins, it doesn't matter, because as long as you're comparing apples to apples, then you know if your gross margin is increasing or decreasing. If you're comparing it to an outside benchmark, you need to know how they calculated that. If they included, vehicle costs or shipping costs or anything like that, fulfillment costs, if they included that in there, then you want to include that in yours. If they don't, then you exclude it. So it depends on what you're comparing it to, honestly. And maybe just to talk kind of high level, a good gross margin for your industry, that really depends on the industry. For foods, it's pretty low, right? You're not going to have a huge gross margin. Retail, you might have a little bit higher of a gross margin because you can mark up your products by 50% or something like that. So it really can vary depending on the industry. I would challenge you to look that up somewhere on the internet. The other thing that is really important is to watch that gross margin as it increases or decreases, because now in this day and age, we talked about tariffs, right? That is going to creep up on everybody somehow, some way. So the question is when do you need to raise your prices? Who's seen effects from tariffs yet? Actually paying tariffs, or are you paying your supplier in the form of increased prices? Yeah, and it's a real thing. So if you haven't seen that yet, if you're buying stuff overseas, then watch out for that, because whether you're paying tariffs directly or not, you'll see something increase, because ultimately your supplier is not going to bear that cost. They're going to pass it on to you. You can't bear that cost. You've got to pass it on to the end consumer. Another thing that it sneaks up on people is merchant fees. I typically like to have people include that in your cost of goods sold. A lot of times that's where it shows up in your tax filing. I actually don't put our merchant fees in my cost of goods sold, just for transparency. And it's going to vary if it's a point of sale, like if you're swiping a card, you should be paying less. You should be around the 2.5% range. If you're online retailing and your customer types in the code, probably be about 2.5 to 3%, depending on the merchant. And if you are collecting the credit card and you're typing that number in yourself, you're paying 3 to 3.5%. As a ballpark, that's where you should be. If you're not paying that, or if you're paying above that, but if you do have a little point of sale system, you can actually go to your bank and they offer some pretty cheap rates a lot of times. Now, profit margin, this is now at the bottom of your income statement. So this is your net income or your operating income divided by your sales. So it's the same formula, it's just instead of the net sales or the gross margin, it's the net income that you're dividing. Do you know your profit margin percentage? That's something if you don't have that, you've got to have your financial statements prepared correctly so that you can just take that and calculate it pretty quick and easy. And that's another one that you want to look at a full year to smooth out any bumps. On these, I like to make sure that I exclude any one-time type expenses. There aren't regular occurring expenses. If you happen to have a legal settlement, you'd want to exclude that because that's not really part of your daily operations. You want to exclude those because it reduces your taxable income. If you can write off your rent, like if you work from home, write off a portion of your mortgage or utilities or your internet bill. So there's a lot of things like that as owners you should be doing, tracking your mileage and writing that stuff off. Yeah, you can get challenged on some of those because if you use it for personal and for business, and if it's owned by the business, technically you should have some of that's personal run through your payroll as earned wages. But when you're looking at your P&L and understanding how you can improve your profit margin. One thing that I like to do is sometimes called right-sizing your P&L, right? I think you guys talked about that in this class. That's taking each expense line item as a percentage of total sales. So you can see like your payroll might be 30% of your total sales. And if you look at that on an annual basis or even a monthly basis, month over month, does that percentage increase or decrease compared to prior months or prior years? If it's increasing, that means that your costs to provide your payroll or your payroll costs are going up faster than your sales are. And if you don't make some changes, you're gonna be in a little bit of hurt because you're paying more than you're pulling in. So you're going the wrong direction. So you got to watch those percentages compared to other historical percentages to see the trend of where your business is heading. Ideally, your expenses are tracking the same or they're reducing compared to revenue. The other things that I see a lot of when people try and cut expenses, one of the easiest things that you can do is look at your subscriptions. How many people have bought a monthly subscription and not used it? Yeah, it happens all the time. We like to do this with our family. We cut out Netflix for a little while and see who complains and how long it takes. And hopefully in the hopes that nobody complains and it just goes away. But that's the same with business. That kind of stuff can get tucked and lost in your financials. I've kind of put together a little makeshift balance sheet here. So we've got cash that adds up into your total assets, and you've got your liabilities, which includes your debt, and then you've got your equity. So if you take your liabilities and your equity, it should equal your assets. So what you should really be looking for is this, and it really depends again on the business. Like an inventory type business, you need to be watching the number of times you turn your inventory every year. And you can calculate that by taking your total annual sales divided by your average inventory balance. Yeah, one of the other important ones is the quick ratio or the current ratio. That's where you look at your current assets and your current liabilities and make sure that it's, and this again depends on the type of business, but you've got to at least have it positive to where you have enough current assets to pay for your current liabilities. Yeah, above 1. Yeah, usually you try and get up to like 2, but again, you don't want to be too high because then you've got idle assets that aren't necessarily earning. The way that the accounting cycle works, you have all your operations here on your income statement, you get your net income, and at the end of the year, that rolls into your net or your retained earnings. Your net income shows up in your equity section. It does, yeah. Owner draws come out of that. Yep. If you're growing and you're growing aggressively and you expand with debt, then your equity is going to be small. But that is a good operation if you want to grow quick and then maybe sell the business. That way you're leveraging other people's money and you're not hampered by slow organic growth. But if I've got a few clients that have no debt whatsoever, and that's another strong position. I mean, think of sleeping at night, you've got $300,000 of cash in the bank and you don't owe anybody anything. Because I actually put this, cash and credit card reconciliations, because that's actually one of the huge pitfalls that I see in a business owner. They think they're reconciling their accounts, but when you look at the reconciliation report, there's a whole bunch of outstanding items on there that aren't ever going to clear because they might have doubled up a transaction, for example, or they've missed a transaction. It'll look like everything's reconciled fine, but it doesn't. This is like super critical. This is like baseline. You've got to have this 100% right in order for this to actually make sense and work. One of my friends in a BNI group that I'm with, and he had me come in and look at his books, and I looked at his reconciliation report, and he had pages of transactions that were back in 2023 that will never clear because somehow they got recorded twice. So the first transaction actually cleared fine, but the second transaction didn't. So he over-recognized expenses by like $20,000 or $30,000. And so in order to fix that, we got to unexpense them, I guess. It's a negative expense, and he's going to have more income going forward. So he thought everything was fine, but when you look at the details, it wasn't. So if you have a good bookkeeper, they should be looking at that reconciliation report regularly to make sure that things are clearing out. Because if that's not working, that's the building blocks of everything else.
Which also impacts like your tax, right? So that could impact your tax liability or your taxable income.
These are the two that we look at the most. There's other super critical reports you got to look at, like your AR aging if you're invoicing. Like you got to watch that AR aging to make sure that people are paying. Give you a suggestion. I've dealt with subscriptions for a long time. All you need to do is send a collection or an email that says to avoid interruption in service. Turn it off and you will get results quick. So this is one that's very specific in Utah. If you call it and say you're passing on the credit card fee to your client, that is illegal and you can't do that in Utah. Yeah, well, if you want to sell, you need to be focused on either your top line revenue or your EBITDA. And I think, did you guys cover EBITDA in here? Yeah. So that's like essentially your operating income. The value of your business is going to be driven off of one of those two numbers.
Your revenue
or EBITDA. Probably most likely it's EBITDA. So if you're looking to sell, that's what you've got to watch. And it's usually a multiple of EBITDA, 3 times, 4 times, 5 times, depending on the industry.
But I guess what I'm saying is, like, if you're forecasting, like, say I want to retire in 10 years. So you start building your forecast to these numbers and just reverse engineer it.
Yeah, if you want to retire with $3 million in the bank, you need to have your EBITDA at $1 million because it sells for 3 times EBITDA. So your goal is to get $1 million of EBITDA by year 10. And then you've got to come up with plans to get to that point. I would recommend at least trying to sell because you've built an asset, like the actual name of the business and in my opinion, we had a client that walked away from a retail business. I tried to get her to at least sell it to somebody. In my CFO planning, that's usually where I start, honestly, is what is your plan? What do you want from your business in the long run? And my exit strategy changes day to day, depending on how busy I am. One of the problems with paying down your debt, right, with all that excess cash is once you pay that, you can't get that back. Very easy. You can do another like a HELOC type of a thing, but then you've got to go through the lending process. Rates are higher. You're going to pay a lot more than 6%. Well, that's all I had. Any questions? Anything else?
Can you do the first 30 minutes again for those? The advice he gave for those 30 minutes was so.
That was the best.